Recording. All right. Welcome everyone to this Lunch and Learn with Eric Ries. Today's focus is going to be largely on talking to investors who have a long-term orientation. If you're here, you probably are looking to raise money or have raised money in the past, and you've probably found some investors that have a long-term orientation, some that don't. Well, this session is all things around that topic. My name's Matt Sherman. I help facilitate some of these conversations to the Long-Term Society, which is a group that Eric and I put together over the last couple of months, and I appreciate you all coming. So to kick this off, we're going to do a recap of our last session. If you weren't there, this is our second session in the series. So Eric, can you kind of give us a high level welcome to the session, high level, like who are you? Remind us, a little bit about you and what was the last session about in like maybe 1 to 3 minutes to give everyone a refresher.
Sure. So hi everybody. First of all, welcome, and thanks for coming, and especially to the folks that are new to the series. One of the challenges that we run into with building startups is that we start out with like some kind of idea of what we're trying to build. And it tends to be something pretty idealistic, sometimes super high concept, like to solve one of the world's largest problems. But sometimes it's something more mundane seeming, like we just want to build a great company. We want to build a place where people can do their best work, or we create the best products. We're dedicated to our craft. But there's some reason why we decided to take a chunk of our lives and devote it to building a startup. And then what happens in the conventional way that companies are built is that spark of inspiration, that soul of the organism, if you will, kind of gets lost. And it's frankly sad. I've been around this long enough to see many companies that just started out as something amazing. Yes, sometimes they still make money, but at the end of it, how happy are we as founders that's what we created? Or another way of putting it, a founder just asked me the other day, is there like a body of work out there on how do we make sure that an organization remains true to the intentions of the people that set it up? And the answer is no, there is no such body of work. It's considered not an important enough problem to be worth studying, according to the people who are the kind of conventional experts on this topic. So we've been trying to develop a theory, just like we did for Lean Startup. Like, what if you want to build a company? We call it being a mission-controlled company, not investor-controlled, not founder-controlled, but mission-controlled. A company that's a trustworthy counterparty to its customers, to its investors, to its community, where you can believe the promises that it makes. How do you go about doing it? Why would you want to go about doing it? And is that a cost or a source of competitive advantage? I think one of the things that people assume when we start talking about mission and impact and things that sound a little bit soft, like it's a social mission kind of thing, they think, oh, we're talking about doing something philanthropic or something that's not tough and serious like business. But my discovery over the past, 10 years now, is that being a mission-controlled company, having a true sense of purpose, and attempting to do something ambitious and long-term in scope is actually a source of competitive advantage. It's not a soft thing. It's actually the hardest of hard things. And if you have friends who have ever been in the situation of competing with a company like that, it's hell on your competitors. That's kind of the idea. So to recap just very briefly the theory so far, the first thing is, what does it mean to be a for-profit company? This is the fundamental misconception in our world today. People think being for-profit is just about making money, but you can make money through extractive, exploitative things or by being truly additive. Our definition here of being a for-profit, to make a profit, is to maximize the amount of human flourishing in the world. So it's still a maximization economic activity, but it's not just about getting money by whatever means necessary. It's always making money by promoting human flourishing. So it's literally impossible to put people over profits. Second idea is that the organizations that we build that are pursuing that purpose are super organisms. They are literally as alive as you or I. And the last idea is that good governance is the structure that allows such companies to be trustworthy counterparties, to prove to themselves and to others that they are dedicated to that for-profit purpose.
All right, so that's a great summary of our last session. If you didn't come to the last session, I'm going to drop the link where you can watch after this session, but feel free to save this link in your browser and you can watch the first Lunch and Learn there. Cool. So thank you for the recap of our last session, Eric. So this session, like I said, is all around investors and how do you talk to investors and everything Eric just said in relation to raising capital. So my second question around this is it's really like, is it what or is it when? What matters more? They both matter a lot, but we'll start with when. This main topic of a lot of the last Lunch and Learn, there's a lot of stuff to potentially do, but let's start with, at what point does it actually matter to get long-term governance into your company? At what point is it too late, when raising from investors? And we'll start there.
Okay, the most important concept here is the phrase I've been using a lot lately, which is that it's always too early until it's too late. So what I've seen this, I've been around so many companies over the years. I've seen this over and over and over again. You have some kind of idealistic idea of what you want to accomplish from a governance perspective. So for example, you want to have a community foundation where you share some of the prosperity that you generate with your key stakeholders, or you want to have, the right voting control, or you want to have a board mission pledge, or you want to do a PVC conversion, or whatever. There's so many things in the menu of legal options. So you wanted to do something like that. You talk to your lawyer who gave you the standard, venture-backed company incorporation package, which unfortunately is very investor favorable. They thought they were doing you a service by doing that, because they figure your goal is to be maximally attractive to investors. And so giving investors all the power makes sense. Okay. You go to them and say, listen, I also, in addition to that, I'd like to do this other mission protective provision, is what they call it in legal circles. They always say the same thing. They're like, there's no reason to do that now. We can always do it later. It's extra expense. It's going to be extra friction. Investors might not like it. Why do it now? Why not just do it later? And founders are always like, okay, yeah, do it later. And then you do this, do some safes. And it's like, is this the right time? You can always do it later. Then you do a Series A, you do a Series B, you start adding investors to your board. Every time you're like, hey, is it the right time? Everyone's like, nah, it's fine. We're all totally supportive of doing that, but why do it now? Anyway, I've seen companies where this bounces along for years. And you get to like the point where you're planning for your IPO. And I've sat there where like now the CEO has not just a lawyer, but they've got a legal department and a CFO and bankers and all these people sitting around the table. And they're like, oh, hey, that community foundation thing. Did we ever get around to doing that? And everyone's like, oh no, were you serious about it? And they're like, oh yeah, you told me it was too early. They're like, oh guys, it's way too late for that. We can't, the IPO documents are prepped. We can't do it now. And I've seen these CEOs get so mad. They're like, wait a second. You're telling me that like 2 years ago on January 7th, it happened to be the right time to do this and nobody mentioned it? Like, of course not. It's only ever too early or it's too late. And that's a continuous process. The longer you go, the more difficult it becomes to make structural changes, unless you invest early in the kind of changes that give you the power to make further changes. So the most important thing is to see this as a continuous process. You might feel like, oh, but I missed my chance. I already incorporated, or I already did this, or I did that. The more outside stakeholders you bring into your governance, the more people you have to convince before you're able to do anything. And the more likely it is that somebody will wind up with an effective veto over the things that you want to do. The first really big inflection point for this, honestly, is not incorporating the company, but it's really the first price round, where you're going to write your first investor rights agreement and potentially bring an investor onto the board. So that's really like the first key moment to try to get stuff done before that happens, so that you've established a precedent that then would carry over into future rounds. But if you miss that window, it's not too late. You can always do it. You can do it between the Series A and the Series B. Certainly, before you start bringing independent directors onto the board, it's really important to have something that constrains their ability to support the mission or not. That's a common issue, is you wind up having independent directors who don't care about the mission and who vote against the interests of the long-term mission. So anyway, that's kind of the way to think about the timeline. And last thing about that is the things that set you up for future success are things that prevent you from having legal liability for doing the right thing, which I know sounds so silly to think about, but most founders, like the standard package that they get from their lawyer, says that they have a fiduciary duty, and so do all their board members, to maximize returns for investors no matter what. So I always ask founders to imagine the nightmare scenario that the most evil company you can think of. My parents are doctors, so I always think of Philip Morris, but you pick your favorite evil company, comes to you and offers you to buy your company for $1 per share more than it's currently worth. They just tell you straight up, we are going to use this to sell cigarettes to children. Most founders think that's a horrible outcome, but most governance experts would say you have a fiduciary duty to sell it. That's your job, to maximize the return for shareholders. So if you do that thought experiment, you realize that we can't have that. That's unacceptable to most founders. I hope everyone here thinks that's a ghastly outcome that we want to prevent. So we want to put in provisions that prevent that from happening. But now here's the problem. The more investors we've taken on before we do that change, the more people there are that might be able later to claim that we defrauded them. The basic in America, anyway, the last crime that companies can really commit is committing securities fraud. So defrauding your investors, misleading them about your intentions is considered like the worst possible crime for a corporation to commit. And there are severe penalties if you do that. And in particular, the courts have the power, if you commit a transgression like that, to invalidate your governance provisions. They can just swoop in and say, sorry, your voting control or whatever you've set up here, it's deactivated because you weren't honest with your investors about what you intended to do. The flip side of that, that's a scary possibility. But the flip side is, especially if you're incorporated in Delaware, under Delaware law, that's like, to me, one of the crowning achievements of the American legal system as it relates to securities law, is the belief is that as long as you and your investors agreed on what's going on, you have incredibly wide latitude to set the company up the way you think is right. So we want to do that as early as possible because that requires the fewest investors possible to have to agree. And then any future investors that come in, they will naturally discover through their due diligence process to the mission, and therefore they can't credibly claim that they didn't know about it. Does that make sense?
100%. Now might be a good time. If anyone has any questions, reminder, put it in the chat. We will cover those after we ask a couple more questions here. So if you have any questions, put it in the chat. So cool. So Eric, I am a founder. I started a company a couple of months ago, and I'm looking to raise capital for my company. And, you know, I get some intros to some great investors that may be brand names in Silicon Valley. And I tell them, hey, you know, I heard from Eric Ries, you know, about this, about building mission control companies. And I have all these provisions in my startup because I want to go long. I want to do it the right way. I want to do the good thing for the world. You agree, right? Like this is good. How do you kind of like talk to investors around your intention, about your own, like the founder's intention to build a mission controlled company when it might be a new topic for some investors and they haven't heard it before potentially?
Yeah, that makes sense. So the typical way this was done in the past, just so you understand kind of where people are, most venture firms have a view about whether they believe in founder-controlled companies or not. So like famously, you know, Google and Facebook and a lot of other companies you've heard of, the founders have special share classes that just give them absolute control. Now, even to this day, Mark Zuckerberg just has absolute control over what's now Meta. And he can't, you know, he can sell a lot of his shares and he still retains his governance control. It's vested in him as a person. He's literally emperor for life. And I think even in Facebook's case, his inheritors, his descendants will inherit that power from him. Like it's basically like a family controlled company. It's positively feudal in its structure. So some investors are really into that. They think founder controlled companies outperform. There's good data to support that that's true. And so they're all in for it. And then there's a set of investors who are really opposed to it and just say, wait a minute, I don't think that's right. I think shareholders should have some kind of view or power. And I think the issue with this is like, when we set it up as investors or founders, we've locked ourselves into a zero-sum combat where someone's gain is somebody else's loss. So I really like the first thing to try to find out is where the investor you're talking to is already on this spectrum. Because if they're investor, they already believe in founder control, then mission control can kind of feel like a similar idea that they're already comfortable with and know about. And in some ways, it's more favorable to them. So they should be already there. If they're anti-founder control, this is potentially a way for them to get over their reservations about it, because being mission controlled it's not really about selfish control. Although in the early days, I do recommend that we vest certain powers with the founder because that's what sets you up for future optionality to get it right. You're not setting yourself up. The goal is not to be emperor for life. Your goal is to set up a governance structure that really promotes this new definition of profit over the long term. So some investors can get excited on that basis. Then frankly, there's a group of investors that just don't care. And I used to get really mad at them. I used to be like, how can you not care? How can you be indifferent to such an important moral question in this world? But they're like, look, we don't care. Our goal is to make money for our LPs. So whatever makes money, that's what we care about. And so actually those investors are kind of, I used to think they were immoral, but they're really more appropriate to call them amoral. They just don't care. So actually, that's great. Because if we can show them that this way of working is a source of competitive advantage, this allows us to attract and retain the best talent, gives us a huge leg up with customers, allow us to bring way better investors into the company, allow us to do better partnerships and build a more trustworthy brand. And there's all these benefits that come from being trusted. Then they're going to be super excited about it. And then there's a category of investors that they want the standard thing no matter what. And then my question is, if you're building a mission controlled company, do you really want those investors on your cap table? So you might, and we can get into this if people want, but like a lot of this has to do with the negotiating leverage that you have and the time that you're raising money. And I think people get so excited, and I do too, like governance stuff and structural stuff and whatever. But at the end of the day, fundraising is about leverage. It's a negotiation. You're buying a product and you're paying a price for it. What you're buying is capital, and what the price that you're paying is what you have to give up to get that capital, which is an equity stake in your company often, but it's often also various forms of control. So the number one advice for all companies, and the best piece of fundraising advice in the world of all time, is just to have better performance. Business traction allows you like a much wider aperture of investor outcomes. But I also think that using this governance stuff, to me, I've had success with it in my career, and I've seen a lot of other people have it too. It's also a way to create positive selection bias. Those investors who are much more likely to support you down the road are the same ones who are going to be excited about you and your mission being at the center of the company. And the ones who are more sociopathic, who are just interested in the standard thing, like they're less likely to be supportive. So that's kind of how I would think about it. Let me pause there and just see what I see. There's a lot of questions coming in, but yeah, just let me know where we should go from there.
Yeah, so both of the questions are around governance. So we'll do one last question, and then we'll dive into the comments. So and if anyone wants to double click on any of these, feel free to put the question in the chat. So I think like very tactfully, like I've actually dealt with this myself with Seed Scout, like in a year or two ago. Like, how do you should a founder be really just upfront on the first conversation saying, hey, like I'm building my company this way? Or like when in the conversation do you share that you're doing something potentially different from what an investor may be used to? Or how do you even get the information if that investor is used to mission control companies, or they just like it the standard way, or they like it founder controlled, or they like it investor controlled? How do you get that information out without jeopardizing the negotiation or jeopardizing the chance that they may want to invest, if that makes sense?
Well, again, it's so interesting that the questions are framed this way. And I'm glad that you're framing it this way, because when you talk to your lawyer, talk to anybody in the world right now, like this is the framing everybody use. If you do anything that's remotely different, people might not like it. And so there's this like negative frame of like, how do you protect against the fact that they might not like it? And of course, the first most important thing is to reject that frame altogether. There are investors out there that like it more. So like those investors are going to be more excited about your company because you're being thoughtful about these issues, not less. And although, yes, there are some who don't like it, there's some that do like it. And you have to, in your industry, your situation, your leverage, you have to make the determination of what's really better. So that's the first thing, is to try to, like, you can usually find out of how an investor thinks about this by just looking at their portfolio. Just like if it's loaded up with mission controlled companies and people who do the stuff, or like, think about, I'll use my friends at Obvious Ventures as an example. Obvious Ventures, their whole investment thesis is to invest in what they call world positive companies. And they put out like an annual world positive report that shows all the positive impact on the world that their companies are having. So like, you don't have to guess. Most investors will make it pretty clear where they stand on this. You think about a firm like Founders Fund. Founders Fund is like very much on the record that founders should be in charge of, like, founder run companies is the way it's right there in the name of the fund. Other firms are more or less vocal, but like you can do your homework ahead of time. Now, the nice thing about having these provisions in your charter and already implemented in the company in advance of a fundraising round is you don't really need to talk about it necessarily. It's not like really important that you establish it in the conversation, and you shouldn't hide it. If you get asked, of course, you should always tell the truth, but you don't have to go in there and be like, oh, rah, rah, I'm a mission control company. It'll show up in the diligence. So they're gonna know one way or the other. So you're not like, there's no rush. You don't have to like make sure they know. Versus if you haven't done it yet, but it's your intention to do it as a part of this round, it's really important that you establish it early on so people know to expect that and can incorporate that into their thinking about the negotiation. That's one of the reasons, one of the main benefits of doing it ahead of time rather than having to do it in the course of the negotiation. And then how do you find out what they think about stuff? Frankly, I would just ask. Most investors are very straightforward on these questions. You can just be like, what do you think of this? You can just say, my belief is that the way to maximize the value of this company is to make sure we take a long-term approach. We take care of these stakeholders, and we do this thing as the mission. This is really what motivates us. This is why our team is here. This is just, you have your arguments ready to go. Just be like, that's what our belief. What do you think? And most investors will tell you they think it's great. And then the catch will come later. Even investors who don't think it's great will often tell you that it sounds great. And Matt and I have helped many founders over the years raise money. I always tell people there's only 3 scenarios you really need to worry about. There's the scenario where there's many bidders. So you have many investors who are excited about your company, and you get to choose which one it is. Well, in that situation, you can use their enthusiasm or lack thereof for these kinds of provisions, for your philosophy of company building, as a filter. And you can just like, oh, look, I have 2 really awesome offers from 2 really awesome name brand firms, one who's really pro this and one who's really anti. Well, I'll take the one from the one who's solved. So there's no downside to having done that in that case. There's a really bad scenario where nobody wants to invest in your company at all. That's not going to be because of your governance. Okay, that's going to be because of the company's performance. And in that case, you're not going to raise any money, so it doesn't matter. So there wasn't no cost to having these things in there. If your company is like so marginal that, and if investors are using that as the excuse why they don't want to invest, you shouldn't believe that. Performance is always the reason. People sometimes use these side issues as a way to like make you feel bad, but I've seen plenty of companies that have something unusual about them. Investors say we won't invest because it's unusual. They get rid of the thing that's unusual. They come back and investors still won't invest. So that's super common. So again, in that case, didn't cost you anything. You got to find a new way forward. And that probably means don't raise money right now. Figure out a new way to have more business performance that will allow you to raise more money. And the only kind of edge case is the situation where you only have one investor who wants to do it. It's happened sometimes where you talk to a whole bunch of people and there's one firm. And they're like, we would like to give you a term sheet. And in that case, you're going to do what that investor wants, right? Like you're going to do it. You're going to, if you truly need the money and there's only one party who can provide it, you're going to have to try to figure out what is the cost. And so they're going to say, look, you have these 10 governance provisions and we don't like 8 of them. So please take them out. Now, if you put in 10 and they make you take out 8, you're still 2 ahead of not having done anything. So I still think you're advantageous to have done it in advance. But then you have to make the decision at a certain point. You'll have that dark night. I've been there where you have to ask yourself, is the compromise I'm required to endure to do this deal worth it? And I don't want to make a joke about it. It's not funny. Like sometimes it is and sometimes it isn't. And I have walked away from stuff that I thought would kill my company. Like I have to have this deal for the company to survive. But I think the cost of the deal is just wrong. I won't do it. And I've had that moment. And sometimes your company does die and it's horrible, but sometimes it doesn't. Turns out actually to be the best thing that ever happened to you. And sometimes you just suck it up and say, yeah, I will compromise because I have to for the survival of the organism that I'm the parent of. So those are hard choices, and nothing we're talking about here can like magically make that go away. But I do think that doing in all 3 of those cases, having adopted these provisions in advance is an advantage to have versus doing it later.
Awesome answer. So that's all the questions that I have. We have a few questions in the chat. For people that have questions, if we'll cover the 3 that are in the chat. If you want to keep your questions like in the realm of investors and fundraising and like in that category, cool. If you have questions that are unrelated, feel free to email me. You can still put it in the chat, but we might just get to them after or in the next session. So with that said, we'll just go in order. John, if you want to ask your question around the ways to structure share classes, this is about one of the provisions you can add in to your governance. Feel free to ask your question, John.
Hi, Eric. Thanks so much for giving these sessions. I really appreciate it. And for some background on me, I'm a lawyer. So these things for other people, I have some specific ideas about doing this in the game industry, but I'll leave that aside. But in terms from an implementation standpoint, you mentioned, there were things that you could do in structuring the share classes in a mission oriented company. What would those things be? Or is there a range of different things? Can you speak to the share class issue?
Yeah. There's a lot of things that you can do. It's a little bit of a general question. I'll just give some examples. Like a very common structure for early stage companies is what are called founders preferred shares. This is a special class of shares that the founders get, usually like 10 or 20% of your overall holdings get converted into this class. So instead of being common shares, they're what are called founders preferred shares. Sometimes they're called Series FF shares. But anyway, they are common shares with that can convert into preferred shares in a future financing. They're very economically favorable to founders. If you've never heard of this, you should ask your lawyer about it. It's a insanely good deal, and something I highly recommend. Well, once you had a separate class just for the founders, it's very natural to use that like a Christmas tree to hang other ornaments on. So then you could say, okay, well then those class of shares also get 10 votes per share instead of 1 vote, or they get special board consideration, or the additional board votes, or there's a bunch of stuff you can do if the founders have special class. So that's one thing that's pretty common. Google actually eventually went to a triple class. So by the way, that when you hear people talk about dual class share structures for public companies, that's usually what they're referring to. Founders have special shares that have special voting rights attached to them. Google, I think, eventually went to a triple share class where they had the high vote shares that the founders had, the common shares that kind of the employees and everybody else had, and then they had a separate class of 0 vote shares, also like a low vote share that some people get. So you can start to get really complicated and fancy with these things. A less common but still pretty cool thing to do, by the way, is to extend the founders' preferred privileges to the founders themselves, but to all your employees, or maybe all your early employees, or even sometimes to your early investors. So I've seen a variety of structures where that benefit can be given. The way I like to think about it, you want to give that benefit to the people you view as the citizens of the republic. If you think about your company as a nation state. So like some investors are just tourists, they're just passing through, especially once you're public. Some quantitative hedge fund or some passive investor that's in every company in your sector, they don't have any special insight or frankly care about the governance of your company because they're not long your outcomes. Quantitative technical investors are often short your position. In fact, many so-called passive long-term investors, they're the ones who provide the shares. They loan their shares out for shorts. They're responsible for the stock loan market. So they're long and short your company at the same time, which is fine. But don't tell me you're a citizen of the republic who should vote in our elections. Give me a break. So anyway, whoever the citizens are the ones who should have the power. And then there's one other, just to give you another example, because this one was just made public. So something called the Anthropic Long-Term Benefit Trust, which is the special governance mechanism that Anthropic, the AI company, uses. It's super cool, super interesting. We don't have to get into it too much, but one of the mechanics is that they have a mission trust who has the job, they're outside experts who have the job to make sure that the company, everything it does is aligned with its ethical principles and is on track, on mission. And yeah, someone's put a link in the chat. Thank you, Andrew. You can check that out. But anyway, the way that the trust is implemented, which I thought was really interesting, is they created a Class T set of stock that is owned by the mission trust and has the governance provisions, the special rights that the trustees have are encoded as a share class within the company. Unlike, for example, OpenAI, where OpenAI is a nonprofit foundation who has a wholly owned for-profit subsidiary. So that's a kind of a similar structure, but accomplished without share classes at all. That's using the foundation structure. In general, for any given kind of governance paradigm that you're interested in, there are many different legal theories or legal mechanisms which it can be accomplished, and finding the right one for your circumstance, that's really a conversation you got to have with a friendly lawyer.
Great answers as always. Josh, good to see you in here. Feel free to ask your question around build, measure, learn in relation to corporate governance.
Yeah, thanks, Matt. Thanks, Eric, so far. I mean, the theme of the question really is how to teaching this better and incentivizing it more. It really feels like the build, measure, learn process, right, is about de-risking future things. Have you had any good examples or used that to talk people into take action now, don't wait? Because you really want to start that experimentation of the company structure early to avoid those problems later.
Totally. I love that connection. Most founders that I talk to, let's just be real here for a second. Most founders I talk to are looking for the one weird trick to solve all their governance problems forever. Okay, that is the real. I'm so busy building my company. I don't have time to talk to my lawyer. All those people are too busy for this stuff. They put it off until later. Or if they're willing to do something, they're just like, give me the one weird trick. And that's basically how Google and Facebook, like most of the previous generation of companies that had some kind of governance innovation, you'll notice it generally tends to be one thing that they were willing to do. Because somebody told them, if you just do this one thing, all your problems will be solved. And if you've watched what happened to those companies, you can easily see the evidence is right before our eyes that it didn't work. It wasn't that it's not that one thing is bad. It's just the whole idea that there's one solution to this problem is incorrect. So as much as I love many of the specific mechanisms that we've talked about here, I don't think any one thing is ever going to solve the problem. And you've already kind of pointed the direction of the reason why, which is like the world is dynamic and changing, and so is the organism. It grows. So this is like asking a parent with a child, like, what's the best, give me the one weird parenting trick that will solve all my parenting problems. It's like, well, do you have a toddler or a 17-year-old? Is it likely to be the same trick? Probably. It's either, in order to do the same trick, it has to be something very abstract, because it's not gonna help. So the same thing is true here. So the way I like to think about it is, you have to view this as a corporate capability. Actually, for those who've read The Startup Way, a big part of The Startup Way was about corporate transformation as a corporate capability, like the ability to reinvent yourself over time. It's like having a startup within the startup. No matter how big your company is, you want to be able to experiment with these things, just as you're saying, Josh, with the build, measure, learn feedback loop. For early stage companies, the way it really works is you need to be continuously looking at every layer of the company, from the board all the way down to the line employees, and to the cut, like every layer, every decision. Is that decision being made to maximize human flourishing, right? Like, is somebody in the room at the time that decision was made, did they have a fiduciary duty to make sure that the right thing happens according to our mission? It's called institutionalizing your intentions, and there's a lot of operational detail. We're focused on fundraising today. We won't get into that too much, but like, it's actually a lot of work, and a lot of founders like, that sounds like too much work, and it's like, great, but it's up to you. But why don't you call me back on your next company, and we'll chat about that. And that is very much parallel to what it was like. I mean, Lean Startup was like that in the early days. People used to be like, I'm not going to have that problem. I'm the next Steve Jobs. I don't need to build, measure, learn. And I used to argue with people like that. And I eventually learned to be like, you know what? It's all good. You call me back on your next company. And I've been at this long enough that many people who have called me back and been like, okay, now I learned my lesson. Now can we do it differently this time? I'm like, God bless, however you get to the right answer is good with me. I don't have a special rule. You have to get it right the first time. Same thing is true here. So I would, like, if I could wave a magic wand for each of you, I would have this be like a meeting you have a couple times a year with your co-founders, and just sit down and like look at everything and just say, what's one improvement we could make here? Or just like, when you have a big issue as part of your retrospective, where you sort of like learn what happened, root cause analysis, 5 whys, whatever you do, ask yourself, like, from a governance perspective, what went wrong here? And you'll start to see, like, there's little glitches. Like, it's not the operating system of my company has just got some bugs. And so if you feel like you're in the routine habit of fixing those bugs, it's much better than looking for the one weird trick.
Cool. We have a question from John, and you slightly answered this, but you didn't go very in depth. And I think it would be interesting to go a little deeper. So, John, feel free to ask your question. And if okay, and I'm assuming you're not in a position to ask, which is totally fine. I'll ask for you. The question is there a way to vet investors for mission mindedness before we reach out to them? I think this is like, I think, yeah. How would you answer that outside of like looking at a portfolio? Because you may not even know which companies are mission minded. You may not even know which ones are mission minded.
Yeah, well, there's a best way, but it's time consuming, which is just to ask a founder in their portfolio what it was like to work with them. And since they might be a real nice person to person A and a real jerk to person B, you really want to talk to all the founders in their portfolio, including the ones that aren't listed on their website anymore. In fact, if I could prioritize one founder to talk to, I'd be like trying to find someone who's not listed on the website. That's probably going to tell you more than what they were like, when everything went great. But even that is imperfect, because maybe there's something unique about your situation that will cause them to act differently. So I'll give you an example. One of my favorite founders, I won't name the company because the personalities involved are all very famous. And so it'll be too easy for you to figure out who I'm talking about. And then we're recording this, so I got to be a little bit careful. But like, they've raised a crazy amount of money from a whole bunch of investors, and they're a very, very, very mission-oriented company. I mean, over the top mission-oriented, to the point that when I first heard the pitch for the company, I was like, man, as much as I believe in this, like, I don't know if investors are there yet. They're ready for something so avant-garde as this. But I was totally wrong. And what's interesting is, not only have they raised a lot of money from very mission-oriented investors, the kind of people you'd expect, they've had a bunch of investors who I would have sworn don't have an emotional bone in their body, who would like totally be transformed by the experience of meeting this company and made investments I would have said they never would do. So sometimes there's something special about your company, but that's on the positive side. Like, they've had some of what I consider some of the worst investors in the world have written them huge checks, which has like caused me to revise my opinion of those investors. Like, well, I guess they're not as bad as I thought. But also there's situations where like someone's got a great reputation, is super nice to everybody in their portfolio, is very mission oriented, but just has a grudge against you. You know, I've seen that too. And obviously we all know situations where you have racial or gender bias or some other kind of bias where, you know, like, I mean, I look the part, right? So I've had lots of investors who treat me really nicely. And then like when I help a female founder raise money, or, you know, a founder from a different background, like they get a very different reaction from those same people. And it always drives me crazy. So like, at the end of the day, what's the phrase? Past results are not indicative of future results. So we never know for sure, which is why I really think positive selection is really your friend, which is just rather than try to filter, put investors in a position to know everything there is to know about your company, and then self-select in or out whether they believe in what you're doing. And that's not a perfect solution. You can't rely only on that. I'll just give you one horror story, which I don't remember if we covered this last time. If so, I'm sorry. I apologize for being redundant, but it's talking about fundraising. One of my favorite companies in my own portfolio, they've raised quite a bit of money, and they had a great investor, like really the best investor in the world for the kind of thing that they do. And they raised, I think, 2 or 3 consecutive rounds led by that investor. They were the lead investor. They were on the board. They were amazing. And I remember having the conversation that we're all having now, this is a few years ago, with the founders, and they're very mission oriented, very ethical. I think very highly of them. And we talked about making sure we put in all these provisions and keep the, you know, we did all the same stuff we're having now. And they you know, talked to their lawyer about it. And the lawyer was like, you can always do it later. And they kind of put it on the back burner. So then years passed, and they called me up, you know, when the market turned from hot to cold recently. They were in market when that happened. They were trying to raise a round. And this great investor that had led their previous rounds, the investor itself had a civil war, and the partners fought, you know, had a fight with each other. And so half the partners left or were thrown out. I don't know. I wasn't following the details, but the critical piece of information is the one partner who was on their board and they were very close to was in the losing faction of the civil war, and he left. And then a new person shows up to take his place, a person they've never met before. And is like, hi, I'm your new representative from firm X. I hear you guys are trying to raise money. And they're like, oh yeah, we are. Will you help us? He's like, well, what's in it for me? And they're like, well, what's in it for you is we're one of your portfolio companies. You invest a ton of money here. You're going to make a lot of money. He's like, I know, but what's in it for me? And he had a bunch of concessions he wanted in exchange for his support for the fundraise. He wasn't going to give them any money, by the way. He's just going to not exercise his veto rights to block the round from being raised in order to get what he wanted. And they called me in a panic. I said, well, first question is, did you guys put in all those provisions we talked about all those years ago? And they were like, no, we never got around to it. It's like, well, this is going to be, then buckle up, because it's going to be a rocky ride. Now, if they had put those provisions in, we would have been able to tell that guy, F you have no power here. And that would have been the end of it. But it wasn't. And it was a very sticky situation, very difficult. So the thing to remember is that investors are also not monolithic. An investment firm is also a company. It is itself a superorganism. And if you want to be really cheeky, you can ask them about their governance structures. How can I trust that the things that they're telling me now, they're going to do in the future? And often the answer is, well, you just got to trust me. You know, the most common answer is, well, that would be terrible for our reputation if we ever were to violate your trust, so don't worry. Which is another way of saying that if the money is enough, they will do it, right? Because like there's some amount of money that they can make that would be worth having their bad reputation. And unfortunately, there's a lot of investors with terrible, terrible reputations that they get away with it because if founders turn over and we don't talk to each other enough. So it's actually it's a shame. The very best investors have to often compete with people who I'm like, their reputation is terrible, but the founder doesn't know. Anyway, sorry, we're getting off track here, but the key thing is just let positive selection be your friend. I really believe in go hard on being clear about what you stand for. And Matt and I were actually talking about this earlier today. We were working with a founder who wasn't sure what their mission was and wasn't sure how to articulate it and was kind of a little bit embarrassed about it. And I really believe, just this is now speaking more as a human, more than just as a startup person or like as a scientist, right? Like the bedrock belief, the commitment that underlies all other commitments, the value beneath all other values is a commitment to the truth, right? Not just to speak the truth, but to accept the truth, the world the way that it actually is. And so the truth of the situation is like, if you are motivated to build your company for some reason, whatever that reason is, to be honest about that and embed that into the structure of the company so that everyone who comes into encounter with you, like they find out what you're really about and they can make a fully informed choice about what kind of company you actually are. The positive selection effects of that far outweigh the feeling of vulnerability you have, to really put yourself out there and to admit that each of us is different and are motivated by different things.
We have a couple more questions here, and also Kelly's will be a good one to round us out, so we'll ask that in a couple. Apologies if I pronounce this wrong, but Raghav, feel free to ask your question. I think this is a very relevant question, so feel free to ask. And I'll assume that you're not in a position to ask, which is totally fine. I'll ask for you. Thanks for the great question. It is, what are your thoughts on the camel approach to building, which means building a company at a steady pace, focusing more on profitability than actively raising funds in relation to this whole conversation?
I haven't heard that referred to as the camel approach before, but I like it. I like that. That's a cool idea. Yeah, listen, I'm very much in favor. So one of the things that drives everybody crazy about me is that I believe that fundraising strategy should be an output of business strategy and not the other way around. So depending on the kind of business it is, we can determine what the optimal fundraising approach is, which means sometimes bootstrapping is best, sometimes venture is best, sometimes, angel checks is best, sometimes, big fancy firms is best. And I'll just to make it really obvious, if you're building like a dating app or something, your capital needs and capital structure is like totally different. I was literally just talking to a company that's building a new semiconductor fab. And so, you want to build a semiconductor fab, like that can't be done on the cheap. It's insanely expensive. I mean, I speak to someone who spent the last 10 years of my life building a stock exchange from scratch. Like it's super highly regulated. It's super expensive. There's no cheap way to do it. And people have been complaining about this since the creation of lean startup, because people think lean means cheap, but no, lean means being efficient with the resources that are at your disposal, whatever they are. So the advantage of using profitability as your North Star and not having outside investors is that you have complete control over what happens. So you just, life is between you and your customers. If your customers like it, you can do what you like. The disadvantage of such a structure is it's actually very difficult to do two things that are important. One is it's hard to compensate employees appropriately. Because it's hard to establish the market value of equity. And it's hard to make investments into the company because in a bootstrap company, your profits are also your take-home pay. And everyone says that they're not going to be like that. But it's really difficult. When the money's your money and it's sitting there in your bank account, it's very hard not to take it home. And so sometimes those companies are underinvested in their own business. And for companies that have a low margin structure, it can be especially challenging because you're also you can wind up with cash flow problems that outside financing can help mitigate. So it's not that one is better than the other. It's just trying to understand what makes the most sense for the kind of business that you want to be. What is the capital cost structure? But also, it's important not to set this up as an A versus B binary. This is really more of a spectrum because how you get outside capital also matters. So for example, one of the concepts that I've been working on with a number of companies is we raise money in what we call an LTSPV, which is basically like a trust that holds investment funds on behalf of the LPs who are investing. So instead of them investing directly in the company, they invest into the LTSPV. The LTSPV becomes one line on the company's cap table. And the shares in the LTSPV are overseen by a trustee who has the mandate. This is all handled contractually in the establishment of the entity, but their mandate is to support the mission of the company rather than to maximize the short-term returns of the investors who are putting the money in. So that's kind of an intermediate structure that allows you to have the economic benefits of outside investors without the governance interference, and that's appropriate in certain circumstances. So again, really a question for the business first. What is the strategy of what we're trying to accomplish? And after that, we can figure out the rest.
Great. So we'll do 2 more questions. So thank you everyone who put a question in the comment. Kelly, we're gonna, although yours is next in line, we're gonna do yours last. So in 2 questions. We'll do the second to last question. Brian, the second half of your comment. Great question. If you want to ask your question, Brian Jorgensen, feel free.
Yeah, I think so. One thing we've always talked about is bringing in kind of internal talent, our resident citizens, to our group at some point. And it's just from your perspective, from what you've seen, what are some of the most citizen favorable structures and the least favorable from your experience, just to kind of even know what are some of the ends of the spectrum that you've seen?
Oh, sure. So with employees, especially so one of my ideas is that harder is easier. This is very counterintuitive, but when you're doing something truly ambitious, truly difficult, I think I told the story of on our last call of a founder who's trying to reinvent the entire American healthcare system full stack. When you first hear that, you're like, that seems way too hard, man. Just do something small. But he's actually a repeat successful founder. In his previous company, he tried to bite off a little slice of the American healthcare company and system, and he was successful. He made a ton of money. That company went public. Everything went great, except they just optimized their little piece. And he's like, but I didn't actually help anybody be more healthy. So that's not my vision. My vision is to reinvent the whole system full stack. And again, that just sounds so audacious, but then, and it's much more difficult. But it's way easier to bring top talent into your company. You think about the doctors who are finally, I'm going to have a chance to really care for patients. The very best people in the field want to work there. I gave you 100 stories about the competitive advantages they've been given. So having an audacious mission, being really long-term, actually caring about your employees, being trustworthy with that stakeholder group, that's a critical thing for talent acquisition. And so what can we do that's employee favorable? What can we do that's employer unfavorable? Unfortunately, the standard package that most lawyers still do to this day is 4-year vesting with a 1-year cliff and a 90-day post-termination exercise window, which I think is a horrible structure for employees. And, if you ever lived through the process of having to lay people off and they only have a month to raise the capital to buy their options and they can't afford it, I mean, it's really gross. And it, frankly, for a lot of these companies who have a lot of employees, it creates a financial incentive where you may as well lay people off and hire someone new to replace them. It's you just find an equivalent person and bring them in, giving them options struck at today's price to get rid of the people who have options struck at yesterday's price. You're creating incentives to treat people poorly. And I was talking to a founder actually just very recently who did that and just felt awful. It's a really horrible feeling to do it. So I think that's a pretty bad system. What I like better, at LTSE, we do 10-year vesting, which we implement as 2 5-year grants. One grant covers years 1 through 5, and one grant covers years 6 through 10. And we do it that way so that employees can make an apples to apples comparison of their 1 through 5 grant with, if they have a competitive offer from someone else with standard vesting, it'll be roughly comparable there. And they can view the 6 through 10 grant as kind of gravy. They don't have to really believe in it. Most people don't think they're going to be at your company for 10 years. But if they do stay for a long time, what's amazing is that their year 6 through 10 grant was struck at the option price of the company when they joined 6 years ago. So since the top performers, you always have to give them refresh grants anyway, the 4-year vesting is kind of a lie. You wind up having to issue new options in the future, the so-called employee evergreen provision. In most, if you read an S1, there'll always be the fact that a company has to be continually diluted in order to retain its talent. So being more honest about the long-term, so having long-term vesting is just a more honest way to account for things. I think it's actually more employee favorable. Obviously, it's great positive selection value. I only have ever had one candidate who was like, I want to join the long-term stock exchange, but I refuse to accept long-term stock option vesting. And I was like, wow, we dodged such a bullet there. Thank God. I was like, yeah, well, great. Then we can easily agree to part ways because did you see what we wrote on there's the name of the company. It's right there. What are you talking about? So Yeah, I'm a big believer in that employee compensation structure. And then yeah, obviously if you have long-term vesting, you should also pair it with a long-term post termination option exercise window.
Very helpful. That describes your channel update as well a lot better. So appreciate it.
Cool. So we have one last question from Kelly and Andrew. We'll answer your question, and I promise, in an indirect way, as we close out. But Kelly, if you want to ask your question around like how do you find more people, like just ask your question around finding mission-minded people.
Yeah. So if there's a founder, let's say that they're starting a new company and this is the top of mind for them, they want to be very diligent about doing this. If there's a lot of time in researching all these people, it might not be super time efficient. Is there any place yet that we know where we can find people who are willing to do the kind of more experimental approach, or kind of what Josh was talking about? Like, I know this is going to take some working, like, where are those people?
Oh, meaning in terms of other founders?
No, maybe like board of directors or investors, or
yes,
the collection of people.
We're working on it. Yeah.
Oh, okay.
Join the Long-Term Society group. This is all new and avant-garde. And it's funny, I've met with a lot of founders over the past couple of years who at the end of the call, they're like, where can I go to learn more about this? Or where's the handbook? Or how can I? And it's like, no, sorry, you're at the cutting edge. You now have all the information that exists on this topic. We're breaking new ground here. So yeah, there's a little bit of having to do this from first principles basis, but we are working on a directory of affiliated vendors. Like I've been working with a number of lawyers and law firms who are willing to work with founders on this stuff. So if you need a lawyer a referral, I have both the like really famous like name brand fancy people who will do this, and then like the super scrappy cheap people who will do it. So like I've got both ends of the spectrum for those who are looking for that. I'm obviously working on a lot of writing on this topic, but one of the things that we will do in addition to like helping people do matchmaking with investors. And if you need help, if anyone's like live, if these issues are live for anybody, please reach out to Matt or to me. Like we can help match you with investors. We can help match you with vendors. Like we do a lot of that ad hoc anyway, as is. But I hope eventually that we will have templates and kind of like a recipe book of like the specific provisions you kind of pick from like a giant menu of things, and that way you can either do it with a lawyer we recommend, or you could just take those provisions to your existing lawyer and just be like, hey, here's the stuff I want to do. But honestly, right now, if you have a good lawyer, this is the thing that's so crazy to me. Everyone acts like the standard package, the standard governance is like the one universal practice that everybody does. And if you go out into the wider world and talk to successful companies, like almost half the companies are some kind of exception to the standard rules. And you're like, if everyone's an exception, why am I being told I have to do the standard thing? In fact, in what way is the standard thing actually standard? It's not. And most lawyers know this. I don't really understand, like at a deep, deep level, I don't get the value of acting like something is standard when it really isn't. So if you go to your lawyers and just, if you take a few notes, pick a couple things we've talked about: founders preferred shares, board mission pledge, PBC conversion, community foundation, maybe pick those 4, something like that. And just don't ever ask your lawyer what you should do. Don't be like, should I do this? Because they'll always give you the same spiel of like, well, it's too early. You can always do it later. I don't know why. Someone's given this, or like, I need to go research that for the next 25 hours and then I'll come back to you. Like, no, they don't need to do that. Instead, just ask them, hey, could you give me the pros and cons of each thing? Just what are they? Your job is to advise me. What are the pros and cons? And like, what's astonishing to me is how many lawyers I've worked with who are like so antagonistic to doing any of these things. If you ask them the pros and cons, they're like, oh, I can easily do it. The pros and cons are: pro is you'll have more control, you'll be able to avoid this situation, you'll have all this power, you'll make a ton more money, And the con is investors might not like it. And you're like, that doesn't sound that compelling of a reason not to do it. But hey, now that you've told me the pros and cons, you work for me, I'd like to do it. The pros seem to me like they outweigh the cons. Will you implement this for me? And like all good lawyers, they know how to do it. None of these things are technically challenging. They're shrouded in mystery and act like they're so weird, but they're like very straightforward. And so you can just be like, can you set me up with something like what Facebook has? Or can you set me up like what OpenAI has or what Anthropic, like the answer is yes, they can do that for you. And so if they're not doing it for you, I think you have some questions to ask yourself about like what their incentives are, But anyway, at the end of the day, you're the client. So just, ask for what you want.
And it's a good timing that Eric kind of ended on that, because our next session is actually all things working with a lawyer on these provisions. So we don't have a date for that yet, but I'll email all of you when we have a date for that. And just a couple of things to wrap up, some actionable items. This isn't something where you're here for an hour, now you leave and there's nothing to do. There's a lot of ways to plug in further into this kind of stuff. The main 3 ways are: 1, if you are a founder that wants to actually get some legal work done in this realm, like Eric said, there's really expensive lawyers we can connect you to. There's also really inexpensive lawyers that are like also doing great work. So email me if you want to get that work done. Subscribe to our YouTube channel. We got 11 subs. We want like 100, 1,000, 1,000,000 one day. But if you want more of this content to be subscribed to this kind of flow, subscribe. Then lastly, we have a Slack community where it's everyone that kind of aligns with this concept, this purpose is in one community. It's pretty active right now, and it's only getting larger. And outside of that, I just want to thank Eric for kind of shedding all this knowledge for all of us, and thank you everyone for joining this amazing event.
Thanks, everybody.
Andrew, I'll shoot the YouTube URL for you real quick. It's actually, if you scroll up in the chat, you'll see it, but I'll grab it for you. It's right here.
Thank you.
There you go. All right. See you everyone next time. Bye.